Welcome back to the deep dive. You know we love to get into the nitty-gritty of investing, and today we're diving into some really cool stuff.
Oh yeah, this is going to be good.
We're talking Benjamin Graham, the OG of value investing, Warren Buffett's mentor, and we're going to see how his ideas work with something you hear about all the time, dollar cost averaging.
Yeah, dollar cost averaging, it's like the steady Eddie of investing, right?
Exactly. It's all about building a portfolio that can handle anything the market throws at it, no matter how crazy things get. And we know you like to learn fast, so we'll cut right to the chase.
I like that. No time wasted.
So what's fascinating here is how these two ideas, Graham's value investing and dollar cost averaging, work together.
It's kind of like Graham gives you the blueprint for finding these amazing companies, these hidden gems that the market's undervaluing, and then DCA gives you the system for actually buying them without having to be a market timing genius.
Right. So it takes the emotion out of it. You're not sitting there, biting your nails, wondering if you should buy or sell.
Exactly. Just steady, consistent progress.
Okay, let's start with Benjamin Graham. This guy was a legend, literally wrote the book on security analysis, like the actual book. And his ideas are still so relevant today. It's all about finding stocks that are trading for way less than they're actually worth.
It's all about finding those bargains, right? Like finding a dollar bill stuck to a 50-cent piece.
That's a perfect analogy. It's like, why wouldn't you pick that up? And that's what Graham called the margin of safety. It's buying those assets on sale, so you're minimizing your risk.
And he wasn't just gambling. He was doing his homework. He'd really dig into a company's financials, their earnings, their book value, their debt, all that stuff to figure out what it was truly worth.
Yeah, he wasn't messing around. And he had these specific rules for picking these defensive stocks. These are companies that can withstand anything. Like, they're built to last. We're talking about consistent sales, low debt, a long history of earnings, paying dividends consistently, that kind of thing.
Yeah, solid companies. And what's amazing is that these criteria have been updated for inflation over the years.
Oh, really? I didn't know that.
Yep. So it just shows how relevant his ideas still are today. He wanted investors to see past the hype, past all the day-to-day ups and downs of the market, and really understand the underlying value of a business.
So it's about looking at the long term.
Exactly.
Which brings us to his famous Mr. Market analogy. I love this one.
Oh yeah, Mr. Market, classic.
It just makes it so clear how to deal with market volatility. So tell us about Mr. Market.
All right, so picture this. Mr. Market is this, kind of wacky character who shows up at your door every day and wants to buy or sell you stocks.
Yeah.
Some days he's super excited, like over the top happy, and he's offering these crazy high prices for your stocks. Other days he's like totally bummed out, like the world is ending, and he's offering you like pennies on the dollar. Get the picture.
I totally get it.
So Graham's point was, don't let this guy, Mr. Market, with all his mood swings, control your investment decisions. You got to have your own plan.
So smart. I think a lot of us get caught up in the emotions of the market. Like when everybody's panicking, you panic too.
It's natural, but it's not the best strategy.
So instead of freaking out when the market dips, we should be thinking, okay, this is my chance to buy those bargains, right? Like Mr. Market's being irrational, so let's use that to our advantage.
Exactly.
Okay, but before we jump into that, Graham also made this distinction between investors and speculators. Which one are you? Think about that for a second.
Yeah, and that's a big one.
Because Graham saw investors as those with a long-term mindset. They're focused on the value of what they own, not on trying to make a quick buck. Speculators, on the other hand, they're just chasing quick profits. They're trying to time the market, which is super risky.
Yeah. It's like, are you playing a long game or are you just gambling?
Exactly. And this is where dollar cost averaging comes in, or DCA, as the cool kids call it. It's a whole different approach. It's not about trying to perfectly time the market. It's about being consistent.
Consistency is key.
So tell me about DCA. I know the basics, but how would you explain it to someone who's just starting out?
Sure. So with DCA, you're putting in a set amount of money at regular intervals, like every month or every quarter. Doesn't matter what the price is doing. So when the market drops, you're buying more shares because they're cheaper. And when the market goes up, you're buying fewer shares because they're more expensive.
So it's like over time, you're kind of averaging out your purchase price.
Exactly. And that's why it's so good for reducing the impact of volatility, especially if you're not, a day trader with a crystal ball.
Right. Most of us aren't professional traders, so this just makes it so much easier.
Absolutely. And it takes the emotion out of it because you're not constantly second-guessing yourself. You're just sticking to your plan.
It's about discipline.
Totally. And the best part, You can pretty much automate the whole thing. A lot of 401ks do this automatically, or you can set it up with your online brokerage account.
So you can just like set it and forget it.
Pretty much, yeah.
Now, here's where it gets really exciting. We take Graham's principles, finding those undervalued, solid companies he loved, and we combine that with DCA. So we're basically finding these great companies, and then we're buying them steadily over time, no matter what the market's doing.
It's a really powerful combination.
It's like building a value-oriented portfolio on autopilot.
Exactly. It takes a lot of the stress out of it. You don't have to be constantly watching the market. But, like with anything, there are always risks to consider.
Okay, so what are the downsides? No investment strategy is perfect, right? What should we be aware of?
Right, no silver bullets. Well, DCA doesn't guarantee you'll make money, of course. And if the market just keeps going straight up, a lump sum investment might actually do better than DCA.
Interesting. Why is that?
Because with DCA, you're spreading out your investment over time, so if the price keeps rising, you might miss out on some gains by not buying everything all at once.
Got it. Makes sense.
And also, all those repeated buys with DTA, they can rack up transaction costs, especially if you're not careful about which platform you're using.
That's a good point. So while DCA can be a fantastic tool, especially for those of us looking at the long term, it's not always the best option.
Exactly. It depends on your circumstances, your goals, your risk tolerance, all of that.
Okay, so we've got the big picture, but you've brought a ton of research with you today. What are some actionable tips that really jump out at you? Things that our listeners can actually use to make the most of this approach.
Well, first off, definitely check out those automated tools we were talking about. A lot of online platforms make DCA super easy to set up and manage. And don't be afraid to play around with different intervals for your contributions. Like maybe you do monthly, maybe you do quarterly. See what works for you and your budget.
Yeah, it's got to fit your life, right? It shouldn't be a burden.
Exactly. And going back to Graham, he was all about understanding your investment personality. Are you comfortable with risk? Do you want to be hands-on or hands-off?
Because that's going to determine if DCA is even the right strategy for you.
Exactly. Investing should feel empowering, not overwhelming. And, we've just scratched the surface here. There's a ton more to learn about value investing and DCA.
It's a lifelong journey, right? We're just providing a starting point.
Totally. So keep learning, keep digging deeper, and don't be afraid to ask questions.
Now let's dig a little deeper into Graham's defensive stock criteria. It's like a checklist for finding those really solid companies, right? What are the key things we should be looking for?
Absolutely. Graham wanted to minimize risk, so he had specific criteria for identifying companies with really strong financial foundations. For instance, he looked for companies with annual sales of at least $500 million. That's been adjusted for inflation, by the way.
Wow. So we're talking about established businesses here, not some risky startup.
Exactly, yeah. And he also looked at what's called the current ratio. He wanted that to be at least 2, which basically means their assets could easily cover their short-term liabilities. They're not going to be struggling to pay their bills.
That makes sense. It's a good indicator of financial stability.
Yeah, for sure. And of course, debt is a big one. Nobody wants to invest in a company that's drowning in loans.
Right, that's a red flag.
So Graham wanted long-term debt to be less than their net current assets.
So they've got to have more assets than debt, essentially.
Yep, and critically, he wanted to see consistent earnings for at least the past 10 years.
Ah, so no flash-in-the-pan businesses, right? You want to see a proven track record.
Exactly. Steady and reliable. And dividends were another big one for him.
Dividends, yeah. Those are always a good sign, right? It means the company is sharing its profits with the shareholders.
Exactly. Graham looked for uninterrupted dividend payments for at least 20 years.
Yeah.
That shows a real commitment to returning value to investors.
Yeah, it's a good sign that they care about their shareholders.
And he also factored in earnings growth. He wanted to see at least a 1/3 increase in per-share earnings over the past decade. So it's not just about maintaining the status quo. He wanted to see that upward trajectory.
It's about growth. It's about making sure the company is not just surviving, but actually thriving.
Exactly.
And of course, you've got to look at valuation metrics, like the price to earnings ratio and price to book value, all that stuff, right? We want to make sure we're not overpaying for these companies.
Absolutely. Those metrics are crucial for determining if a company is truly undervalued.
Right, because a good company can still be a bad investment if you pay too much for it.
Exactly. Now, I know all of this can seem a little complex, especially if you're not a financial expert.
Yeah, there are a lot of numbers involved.
Right. But even if you don't want to dive deep into the financial statements, you can still apply the core principles. Just start by understanding the businesses you're investing in.
So look beyond the numbers.
Yeah. Do they have strong competitive advantages? Are they consistently profitable? Is the management team trustworthy?
It's about the big picture.
Exactly. And remember, there are tons of resources out there to help you. Don't be afraid to seek guidance from a financial advisor. Or utilize those online tools to research potential investments.
That's a great point. We're all about empowering you with knowledge here on the deep dive, but we're
Yeah.
not financial advisors ourselves.
Right, we're just sharing what we've learned.
So seeking personalized advice is always a good idea. Now, let's circle back to DCA for a moment. We talked about all the benefits, but it's important to remember that it's not always the perfect strategy. Like, if the market just keeps going up, a lump sum investment might actually give you better returns.
That's true. If the market is on a tear, DCA might cause you to miss out on some gains because you're spreading your investment over time.
Right, because you're not buying everything at once.
Exactly. And all those repeated buys with DCA, they can add up to higher transaction costs.
Ah, that's a good point.
So, yeah, while DCA is great for managing risk and staying disciplined, it's not always the optimal choice.
Right. It's all about finding the right tool for the job.
Exactly. But for long-term investors, those benefits often outweigh the drawbacks.
Yeah, consistency and discipline are powerful forces in investing.
Absolutely. And remember, DCA isn't just for stocks. You can use it for ETFs, mutual funds, even cryptocurrencies. It's really versatile.
Oh, that's cool. So you can tailor it to your own needs and risk tolerance.
Exactly. You control the frequency of your contributions, the amount you invest, and the specific assets you're targeting.
It's all about creating a plan that works for you. Now, our listener is all about actionable insights. We've touched on a few already, but any others that come to mind based on your research?
Definitely. Remember those automated tools we discussed? Many online brokerages and robo-advisors offer DCA features that make it super easy to manage your investments. And don't be afraid to experiment with different investment intervals. Maybe monthly contributions suit your budget, or perhaps quarterly works better. It's all about finding what fits your financial flow.
I love those tips. They make DCA seem much less daunting.
It really is simpler than it sounds.
And going back to Graham, remember, he emphasized knowing your own investment personality. Are you comfortable with risk? Do you prefer a hands-off approach?
Right, self-awareness is key.
Because knowing yourself will help you determine if DCA really aligns with your investing style.
Exactly. Investing should feel empowering, not overwhelming. And remember, this is just the beginning of your exploration.
We've given you the foundation.
Now it's up to you to build on it. There's a whole world of knowledge out there, just waiting to be discovered.
So true. Now let's dive a little deeper into Graham's defensive stock criteria. It's like a checklist for finding those rock-solid companies, right? Walk us through those key points.
You got it. Remember, Graham wanted to minimize risk, so he had the specific criteria to help identify companies with strong financial foundations. Like one thing he looked for was companies with annual sales of at least, well, it was originally $100 million, but that's been adjusted for inflation to about $500 million today.
Wow, so we're talking about established businesses here, not some fly-by-night operation.
Exactly. He wanted to see a history of success. And another thing he looked at was the current ratio. He wanted that to be at least 2, which basically means that their assets could easily cover their short-term liabilities. They're not going to be scrambling to pay their bills.
That's a good sign. It's a good indicator of financial stability.
Yeah, absolutely. And of course, debt is a big one. You don't want to invest in a company that's drowning in debt.
Right. That's a recipe for disaster.
Exactly. So Graham wanted long-term debt to be less than their net current assets.
Okay, so they've got to have more assets than debt, basically.
Yep. And he also really wanted to see consistent earnings for at least the past 10 years.
Ah, so no flash in the pan businesses. You
Mhm.
want to see a proven track record of success.
Precisely. And dividends were another thing that he considered important.
Dividends, yeah. Those are always a good sign, right? It means the company is sharing its profits with the shareholders.
Exactly. Graham wanted to see uninterrupted dividend payments for at least 20 years. That shows a real commitment to returning value to their investors.
Yeah, it shows that they're not just hoarding all the cash for themselves.
Right. And he also factored in earnings growth. He wanted to see at least a 1/3 increase in per-share earnings over the past decade.
So he wasn't just looking for companies that were maintaining their current level of profitability. He wanted to see actual growth.
Exactly. It's about making sure the company is not just surviving, but thriving.
Right. And of course, you've got to look at valuation metrics too, like the price to earnings ratio, price to book value, all those numbers, right?
Yes.
You want to make sure you're not overpaying for these companies, even if they are great companies.
Exactly. Those are crucial for determining if a company is truly undervalued.
Because even a fantastic company can be a bad investment if you pay too much for it.
100%. Now, I know all this might seem a little overwhelming, especially if you're not a financial whiz.
Yeah, it's a lot to take in.
But even if you don't want to spend hours poring over financial statements, you can still apply the core principles. Just start by understanding the businesses you're investing in.
So it's about looking beyond the numbers.
Right. Ask yourself, do they have a strong competitive advantage? Are they consistently profitable? Is the management team trustworthy? Things like that.
It's about the big picture.
Exactly. And there are tons of resources out there to help you.
Hmm.
Don't be afraid to reach out to a financial advisor or use online tools to research potential investments.
That's a great point. We're all about empowering you with knowledge here on the deep dive, but we're not financial advisors ourselves.
You're just enthusiastic about
Yeah.
investing.
So seeking personalized advice from a professional is always a wise move. Now let's circle back to DCA for just a moment. We've highlighted all the benefits, but it's also important to remember that it's not a magic bullet. Like if the market keeps going up, a lump sum investment might actually give you a better return.
That's true. If the market is on a roll, DCA might cause you to miss out on some gains because you're spreading out your investments over time.
Right, because you're not buying everything all at once at the lower price.
Exactly. And all those repeated buys with DCA can also mean higher transaction costs, especially if you're not using a platform with low fees.
That's a good point. So DCA is a great tool for managing risk and staying disciplined, but it's not always the optimal choice.
Exactly. You got to choose the right tool for the job.
But for long-term investors, the benefits of DCA often outweigh the drawbacks.
Absolutely. Consistency and discipline, they're key to successful investing over the long haul.
I love that. Now, our listener is all about those actionable takeaways. We've covered some already, but are there any others that come to mind?
Yeah, definitely. Think about those automated tools we were talking about earlier. Many online platforms and robo-advisors offer DCA features, and they make it super easy to manage your investments. And don't be afraid to experiment with different intervals for your contributions. See what works for you. Maybe you like to contribute monthly, maybe quarterly. It's all about finding that sweet spot for your budget and your lifestyle.
I love those tips. They make DCA seem so much more approachable.
It really is easier than it sounds. And don't forget what Graham said about knowing your own investment personality. Are you comfortable with risk? Do you want to be super hands-on, or do you prefer a more hands-off approach?
Because that's going to play a big role in determining if DCA is even the right strategy for you.
Exactly. Investing should feel empowering, not overwhelming. And remember, we've just scratched the surface here today.
Yeah, we're just getting started.
There's so much more to learn about value investing in DCA.
It's a lifelong journey, right?
Absolutely. So keep learning, keep exploring, keep digging deeper, and don't be afraid to ask for help along the way.
Now, before we move on, let's get back to those defensive stocks that Graham was so fond of. It's like he created a checklist for finding those super solid companies, right? Can you walk us through some of the key points?
Absolutely. So remember, Graham was all about minimizing risk. He wanted to help people find those companies that were built to last, so he came up with these criteria to identify companies with really strong financial foundations. Like, one thing he looked for was companies with a minimum amount of annual sales, originally $100 million, but that's been adjusted for inflation to about $500 million today.
So we're talking about established businesses, not just startups.
Exactly. He wanted to see that track records of success, and he also looked at what's called the current ratio. He wanted to see that be at least 2. Basically, this means their assets could easily cover their short-term liabilities. They're not going to be struggling to pay their bills.
Right, you want them to have that financial stability. It's a good sign.
Absolutely. Right. And of course, debt is always a big one. Nobody wants to invest in a company that's drowning in debt.
Yeah, debt can be a killer.
Right. So Graham wanted long-term debt to be less than their net current assets. They basically need to have more assets than debts.
Makes sense. You don't want them to be in over their heads.
Exactly. And another thing he was really big on was consistent earnings. He wanted to see consistent earnings for at least the past 10 years.
Ah, so no flash-in-the-pan companies. You want to see that steady, reliable track record of profitability.
Precisely. He wanted to see those companies that have proven themselves over time. And speaking of consistency, dividends were another key factor for Graham.
Dividends are always a good sign, right? It shows that the company is sharing its profits with the shareholders.
Exactly. Graham wanted to see companies that had paid dividends uninterrupted for at least 20 years.
Wow, 20 years. That's a long time.
Yeah, it is. It really shows their commitment to returning value to the investors,
Yeah, actions speak louder than words.
for sure.
Yeah.
And he also looked at earnings growth. He wanted to see that companies were growing their earnings per share by at least a third over the past decade.
So he wasn't just looking for companies that were staying afloat. He was looking for those that were actively growing and expanding.
Right, because that's where the real potential is.
Now, of course, we also have to consider those valuation metrics like, price to earnings ratio, price to book value, all those numbers that help us determine if we're actually getting a good deal.
Absolutely. Those are crucial for making sure that a company is truly undervalued.
Because even a fantastic company can be a bad investment if you pay too much for it.
Exactly. It's about finding those hidden gems, those
Yeah.
companies
Yeah.
that the market hasn't fully recognized yet.
I love that image. And speaking of hidden gems, you've brought a ton of research with you today. What are some actionable tips or insights that you've uncovered that our listeners can use to make the most of Graham's approach and really put these ideas into practice?
Okay, well, first off, let's talk about those automated tools we mentioned earlier. A lot of online platforms and robo-advisors make DCA super easy to set up and manage. And don't be afraid to experiment a little with different intervals for your contributions. See what works for you and your budget. Maybe you prefer to contribute monthly, maybe quarterly. It's all about finding that sweet spot.
Those are great tips. They really make DCA seem much less intimidating.
It really is simpler than people think. And going back to what Graham said, remember the importance of understanding your own investment personality. Are you comfortable with some level of risk, or do you prefer a more hands-off approach? That kind of self-awareness is going to be key in figuring out if DCA really aligns with your investing style.
Right. Because ultimately, investing should be a journey that you feel good about, not one that keeps you up at night with worry.
Absolutely. And remember, we've only just scratched the surface here. There's so much more to explore and learn about value investing and DCA.
It's a lifelong journey, right?
Exactly. So keep learning, keep exploring, and keep asking questions.
Yeah.
That's how we all grow as investors.
Love it. Now let's circle back to those defensive stocks that Graham was such a big fan of. It's like he developed this whole checklist for identifying those companies that are built to last.
He did. He really wanted to help people find those rock-solid investments that could withstand any market storm.
So can you walk us through some of the key points on his checklist? What should we be looking for?
Sure. Remember, Graham was all about minimizing risk. He wanted to make sure that people were putting their money into companies with truly strong financial foundations. So one of the first things he looked at was a company's annual sales. Originally, he set the minimum at $100 million, but that's been adjusted for inflation to about $500 million in today's dollars.
Wow. So we're talking about established businesses here, not some fledgling startup.
Exactly. He wanted to see a proven track record of success. And another thing he looked at was the current ratio. He wanted that to be at least 2, which essentially means that their assets could easily cover their short-term liabilities. They're not going to be struggling to pay their bills.
Right. You want to see that financial stability. It's a good sign.
Absolutely. And then, of course, we have to talk about debt. Nobody wants to invest in a company that's drowning in debt.
Yeah, debt can be a real drag on a company's growth.
Exactly. So Graham wanted to see that a company's long-term debt was less than their net current assets. They've got to have more assets than debts.
Right. You want to see that they're in a solid financial position.
Exactly. And he was also really big on consistent earnings. He wanted to see consistent earnings for at least the past 10 years.
So no flash-in-the-pan companies. You want to see that they can deliver consistent profits over the long haul.
Precisely. And dividends were another important factor for Graham.
Dividends, yeah. Those are always a good sign. It shows that the company is sharing its profits with the shareholders.
Exactly. Graham was looking for companies that had paid dividends uninterrupted for at least 20 years.
20 years. That's impressive.
It is. It shows a real commitment to providing value to their investors.
Actions speak louder than words, right?
Exactly. And, of course, he also factored in earnings growth. He wanted to see companies that were consistently growing their earnings per share by at least a third over the past decade.
So he wasn't just looking for companies that were treading water. He was looking for those that were expanding and growing their profits.
Precisely. Because ultimately, that's what drives long-term returns for investors.
And of course, we have to remember those valuation metrics like the price to earnings ratio and price to book value, all those numbers that help us determine if we're getting a good deal.
Absolutely. Those are crucial for making sure that a company is actually undervalued.
Because a great company can still be a bad investment if you overpay for it.
Exactly. It's all about finding those hidden gems, those companies that the market hasn't fully recognized yet.
I love that. So let's talk about those hidden gems. You've done a ton of research for today's show. What are some actionable tips or insights that you've uncovered that our listeners can use to really make the most of Graham's approach and put these ideas into action?
Sure. Well, first of all, remember those automated tools that we were talking about? A lot of online platforms and robo-advisors offer DCA features that makes managing your investments super easy. And don't be afraid to play around with different intervals for your contributions. Maybe monthly works for you, maybe quarterly. It's about finding that sweet spot for your budget and your lifestyle.
Those are some really great tips. They make DCA seem much less daunting.
It really is simpler than people think. And going back to what Graham said, it's so important to understand your own investment personality. Are you comfortable with risk? Do you like to be really hands-on with your investments, or do you prefer a more hands-off approach?
Because that's really going to influence whether or not DCA is even the right strategy for you.
Exactly. Investing shouldn't be a stressful experience. It should be something that you feel empowered by. And remember, we've really only just scratched the surface here. There's so much more to learn about value investing in DCA.
It's a lifelong journey of learning.
Exactly. So keep learning, keep exploring, keep asking questions. That's how we all grow as investors.
I love that. Now, let's go back to those defensive stocks that Graham was such a big fan of. It's like he developed this checklist for finding companies that were built to last.
It did. He was really focused on helping people identify those companies that could weather any storm, those rock-solid investments.
So, what are some of the key points on his checklist? What should our listeners be looking for?
Absolutely. So Graham was all about minimizing risk, right? He wanted to make sure that people were investing in companies with really strong financial foundations. And one of the first things he looked at was a company's annual sales. Originally, he set the minimum at $100 million, but that's been adjusted for inflation to about $500 million in today's dollars.
Wow, so we're not talking about your average startup here. These are established players.
Exactly. He wanted to see that proven track record. And he looked at what's called the current ratio. He wanted that to be at least 2, which means their assets could cover their short-term liabilities. Basically, they can easily pay their bills.
That's reassuring. You don't want a company struggling to stay afloat.
Right. And of course, we have to talk about debt. No one wants to invest in a company drowning in debt.
Yeah, debt can be a killer.
Exactly. So Graham wanted long-term debt to be less than their net current assets. Basically, more assets than debt.
Makes sense.
And another thing he was really big on was consistent earnings. He wanted to see at least 10 years of consistent earnings.
So you're looking for steady, reliable earners, not companies that are here today, gone tomorrow.
Right. He wanted to see companies that had proven they could weather different economic conditions. And speaking of consistency, dividends were another important factor for Graham.
Dividends are always a good sign, right? It means the company is sharing its profits with its shareholders.
Exactly. Graham was looking for companies that had paid dividends without interruption for at least 20 years.
Wow, 20 years. That's a pretty solid track record.
It is. It shows a real commitment to returning value to their investors.
Yeah, it's a good sign they care about their shareholders.
And of course, he also considered earnings growth. He wanted to see that a company was growing its earnings per share by at least a third over the past 10 years.
So not just maintaining the status quo, but actively growing.
Exactly. Because ultimately, that's what drives long-term returns for investors.
Now, I've got to talk about valuation metrics too. Things like the price to earnings ratio, the price to book value, all those numbers that can help us determine if a company is truly a bargain.
Absolutely. Those are really important for making sure that you're not overpaying for a company, even if it's a great company.
Because a great company, it can still be a bad investment if you pay too much for it.
Exactly. It's about finding those hidden gems, those companies that are maybe a little bit under the radar.
I love that idea. So let's talk about those hidden gems. You've done a ton of research for us today. What are some actionable insights that you've come across that our listeners can actually use? Tips that can help them apply Graham's approach and really make the most of these ideas.
Well, for starters, definitely check out those automated tools we were talking about earlier. Many online platforms and robo-advisors have DCA features built right in, and they make it super easy to manage your investments. And don't be afraid to play around with different intervals for your contributions. See what works for you in your budget. Maybe monthly is your thing, maybe quarterly. It's all about finding what works best for you.
Yeah, it should be something that fits your life, not something that feels like a chore.
Exactly. And speaking of finding what fits, remember what Graham said about the importance of understanding your investment personality. Are you comfortable with risk? Do you like to be really hands-on with your portfolio, or are you more of a set it and forget it kind of investor?
Right, because that's going to play a huge role in determining if DCA is the right approach for you.
Exactly. Investing shouldn't be something that stresses you out. It should be something that makes you feel empowered and confident. And, remember, we've only just scratched the surface here today. There's a whole universe of information out there about value investing in DCA.
It's a journey, not a destination.
Well said. So keep learning, keep exploring, keep asking questions. That's how we grow as investors.
I love that. Now let's go back to those defensive stocks that Graham loved so much. It's like he created this checklist for finding the kinds of companies that were built to last.
He did. He really wanted to help investors identify those companies that were like, the rocks of the market, steady and reliable, no matter what was going on in the world.
So what are some of the key things on his checklist? What should our listeners be looking for when they're trying to find those defensive stocks?
Well, first and foremost, Graham was all about minimizing risk. He wanted to make sure that people were putting their money into companies with really strong financial foundations. So one of the things he looked at was annual sales. Originally, he said that a company should have at least $100 million in annual sales, but that's been adjusted for inflation to about 500 million in today's dollars.
Okay, so we're talking about serious players in the market, not tiny companies.
Exactly. He wanted to see a track record of success. And another thing he looked at was the current ratio. He wanted that to be at least 2, which basically means that a company has enough assets to cover their short-term liabilities. They can pay their bills without any problems.
Right. You want to see that they've got that financial stability.
Exactly. And then, of course, we have to talk about debt. Nobody wants to invest in a company that's drowning in debt.
Yeah, debt can be a huge burden.
Exactly. So Graham wanted to see that long-term debt was less than the company's net current assets. So basically, they have more assets than they have debts.
Makes sense. You don't want them to be in over their heads.
Right. And another big thing for Graham was consistent earnings. He wanted to see companies that had shown consistent earnings for at least the past 10 years.
Ah, so no flash-in-the-pan companies. You want to see those steady earners.
Exactly. He wanted companies that had proven they could weather different economic cycles.
Mm.
And you know what else he considered important? Dividends.
Dividends, yeah. Those are always a good sign, right? It means the company is sharing its profits with its shareholders.
Exactly. And Graham was looking for companies that had paid dividends uninterrupted for at least 20 years.
Wow, 20 years. That shows a serious commitment to their investors.
It does. It shows they really prioritize returning value to their shareholders. And of course, Graham also looked at earnings growth. He wanted to see companies that were growing their earnings per share by at least a third over the past 10 years.
So not just maintaining, but actively growing their profitability.
Right. Because ultimately, that's what creates long-term value for investors.
Now, we can't forget about those valuation metrics. Things like the price-to-earnings ratio, the price-to-book value, all those numbers that can help us determine if we're getting a good deal.
Absolutely.
Yeah.
Those are crucial for making sure that you're not overpaying, even if it's for a fantastic company.
Because a great company can be a bad investment if you buy it at the wrong price.
Exactly. It's about finding those hidden gems, those companies that are maybe a little bit undervalued by the market.
I love that. So let's talk about those hidden gems. You've brought so much great research for us today. What are some actionable tips or insights that our listeners can use to find those hidden gems? Ways to apply Graham's approach and really get the most out of these ideas.
Well, first of all, don't forget about those automated tools we talked about earlier. Many online platforms and robo-advisors have features that make DCA super simple. You can set it and forget it. And don't be afraid to experiment with different intervals for your contributions, too. Maybe monthly works best for you, maybe quarterly. It's all about finding what fits your budget and your lifestyle.
Those are some really great tips. I think they make DCA a lot less intimidating.
It really is easier than people think. And, going back to what Graham said, it's really important to understand your own investment personality. Are you comfortable with risk? Do you like to be really hands-on with your investments? Or would you rather take a more hands-off approach?
Because that's going to make a big difference in determining if DCA is even the right approach for you.
Exactly. Investing shouldn't be something that keeps you up at night. It should be something that you feel good about, something that you feel empowered by. And, remember, This is just the beginning of the journey. There's so much more to learn about value investing in DCA. We've just scratched the surface here today.
It's a lifelong journey, isn't it? Always learning, always growing.
Absolutely. So keep learning, keep exploring, and don't be afraid to ask questions. That's how we all become better investors.
I love that. So we've talked a lot about Graham's criteria for finding those rock solid companies, those defensive stocks that can really anchor a portfolio. But where do we even begin to look for these companies? Are there any particular industries that tend to be good hunting grounds for value investors? What about screening tools? Are there any online resources that you can recommend?
Those are great questions. And, the beauty of value investing is that it can be applied across a wide range of industries. You don't have to limit yourself to any particular sector.
So really, it's about applying those core principles of looking for undervalued companies with strong fundamentals, no matter what industry they're in.
Exactly. Now, of course, some industries might be more fertile ground for value investors at different times.
Hmm.
Like right now, with interest rates rising, you might find some interesting opportunities in the financial sector.
Yeah.
Banks, insurance companies, that kind of thing.
Ah, that makes sense because those businesses tend to benefit from higher interest rates, right?
Right. They can earn more on their loans and investments.
Yeah.
But, you don't want to just blindly jump into a sector because it seems hot at the moment.
Yeah.
You still have to do your due diligence. You still have to apply those Graham principles and make sure you're investing in quality companies at a reasonable price.
So don't chase trends.
Exactly. Stick to your strategy. Now, as for screening tools, there are definitely some great resources online that can help you filter through all the noise and find potential value investments. A lot of brokerages have their own screening tools built right in where you can set parameters like market cap, price to earnings ratio, dividend yield, that kind of thing.
So you can narrow down your search and find companies that meet your specific criteria.
Exactly. And there are also some really good independent websites and services that specialize in value investing screening. One of my favorites is called Guru Focus. They have a ton of different screening filters based on various value investing philosophies, including Graham's principles.
Oh, that sounds like a great resource. We'll definitely put a link to that in the show notes for our listeners.
Perfect. And, another great resource, and it's one that a lot of people overlook, is simply reading company reports. Don't just rely on those third-party websites and analysts. Go straight to the source.
Get your hands dirty.
Exactly. Read those 10Ks, those annual reports that companies file with the SEC. They can tell you so much about a company's financials, their management team, their overall strategy. It's all right there, black and white.
That's a really good point. Sometimes we forget that there's a wealth of information available for free directly from the companies themselves.
Absolutely. So don't be intimidated by it. Dive in, read those reports, and get to know the companies you're considering investing in.
Okay, so we've talked about screening tools, company reports. Those are great resources. But what about those intangible factors, those things that you can't necessarily quantify on a spreadsheet? Things like management quality, competitive advantage, the overall culture of a company. How do we assess those things as value investors?
Those are really important factors to consider, and they can definitely be a little bit harder to assess than those hard numbers on a balance sheet. But there are ways to get a sense of these things. Like for management quality, you could look at a company's track record. Has the management team made smart decisions in the past? Have they delivered on their promises? Have they created value for shareholders?
So look at their history, their actions.
Exactly. And you can also read interviews with management, listen to earnings calls, get a feel for their vision for the company, their leadership style, their overall competence.
So it's about doing your homework, not just relying on those numbers alone.
Right. And as for competitive advantage, you want to look for companies that have something that sets them apart from the competition. Maybe it's a unique product or service, maybe it's a strong brand, maybe it's a really efficient operation.
Something that gives them an edge.
Exactly.
Yeah.
Something that makes it hard for competitors to copy them. And the overall culture of a company is important too. You want to invest in companies that treat their employees well, that have a good reputation in the community, that are ethical and responsible in their business practices.
So it's about investing in companies that align with your values.
Absolutely.
Yeah.
Because ultimately you want to feel good about the company you're investing in.
Yeah.
You want to be able to sleep well at night knowing that your money is supporting businesses that are making a positive impact on the world.
That makes a lot of sense. It's not just about the financial return. It's about investing in something that you believe in. Now, one thing that I hear a lot is that value investing is dead. that it worked in Graham's day, but the markets are so different now, so efficient that it's impossible to find those hidden gems anymore. What's your take on that? Is value investing really dead?
Well, I've heard that argument too, and I think it's completely wrong. Value investing is not dead. It's just evolved. The markets are definitely more efficient than they were in Graham's day, but that doesn't mean that there aren't still undervalued companies out there. It just means we have to be a little bit more creative, a little bit more diligent in our research.
So the game has changed, but the principles still apply.
Exactly. The core principles of value investing, buying companies for less than they're worth, focusing on the long term, managing risk, those things are timeless. They will always be relevant.
So it's not about trying to beat the market. It's about making smart, informed decisions and building a portfolio that can withstand the inevitable ups and downs of the market.
Exactly. It's about playing the long game and letting those compounding returns work their magic over time.
Now, before we wrap things up, you mentioned earlier the concept of insider buying. When executives or directors of a company buy shares of their own stock, can you talk a little bit more about that? Why is insider buying seen as a positive sign for investors?
Sure. So insider buying basically means that people who are on the inside of a company, people who have access to all the information about the company's performance and prospects, are putting their own money on the line. They're buying shares of their own stock. And that's a really powerful signal to the market. It's basically saying, we believe in this company. We think the stock is undervalued, and we're putting our own money where our mouth is.
So it's like they're putting skin in the game, right? They're not just talking the talk, they're walking the walk.
Exactly. And, while insider buying isn't a foolproof indicator, it's definitely something that value investors pay attention to. It's one more piece of the puzzle, one more data point that can help them make informed decisions.
So it's like a little bit of extra reassurance that you're on the right track.
Exactly. It's like getting a little nod from someone on the inside saying, hey, this is a good bet.
I love it. Okay, so we've covered a lot of ground today. We've talked about Benjamin Graham, the father of value investing, his timeless principles, his famous checklist for finding those rock-solid defensive stocks. We've explored the power of dollar cost averaging, how it can help us manage risk, build discipline, and create a portfolio that can weather any storm. We've even talked about insider buying and the importance of doing our own research, reading company reports, and really understanding the businesses we're investing in. It's been a fascinating journey, and I hope our listeners feel empowered to take control of their financial futures and start building wealth on their own terms.
Me too. I think the most important thing is to remember that investing isn't just about picking stocks or trying to time the market. It's about building a solid financial foundation for yourself and your family. It's about creating a future where you have the freedom and security to live the life you want. And, I truly believe that everyone has the ability to achieve financial success if they're willing to learn, be patient, and stick to their plan.
Beautifully said. And on that note, we'll wrap up this episode of The Deep Dive. Thank you so much for joining us today. And remember, the journey to financial freedom starts with a single step. So what are you waiting for? Take that step today.
Exactly. It's all about building that solid foundation.
So we've covered a lot of ground today. We've talked about Benjamin Graham's value investing wisdom, the power of dollar cost averaging, even those tricky intangible factors like management quality and company culture. It's been a deep dive for sure.
Deep dive indeed.
But now the big question is, how can you, dear listener, actually use all of this? How can you take these ideas and start building your own rock-solid portfolio? What do you envision for yourself a few years down the line?
Yeah, let's get practical. Imagine it's a few years from now, and you've been consistently investing in those solid, undervalued companies, using DCA to snag those sweet deals, even when the market's going haywire. You haven't let Mr. Market's mood swings mess with your head. You've stayed focused on the long game. You've been patient. You've done your research. What does that portfolio look like?
Oh, I can see it now. It's a portfolio that's not just holding its own, it's thriving. It's weathered those inevitable market storms because it's built on a solid foundation of quality companies. And it's steadily growing thanks to the power of compounding and those smart investment choices. That's the beauty of this approach, combining Graham's wisdom with the discipline of DCA.
Couldn't have said it better myself. And remember, those companies buying back their own stock, that's often a sign of a company that believes in itself. Management's putting their money where their mouth is. They see the value that maybe the market hasn't quite caught up to yet. It's a good sign to look out for.
It's like finding a captain who loves their ship so much, they're investing their own money in it. Definitely builds confidence. But before we wrap up, I just want to remind everyone that this is just the beginning. We've laid the groundwork here, but there's a whole world of knowledge out there about value investing and DCA. A lifetime of learning, really.
Absolutely. Never stop exploring, never stop digging deeper. There are so many resources out there, books, articles, podcasts, financial advisors, online communities. Don't be afraid to reach out, ask questions, get guidance.
And remember Graham's core message. Investing isn't some get-rich-quick scheme. It's about building a strong financial foundation for yourself and your family based on those timeless principles, those solid companies, and that long-term perspective. Time is your greatest ally, and knowledge is your most powerful tool.
Couldn't agree more. So go out there, embrace those principles, invest wisely, be patient, and watch your financial goals come to life.
Thanks for joining us on the deep dive, folks. Until next time, happy investing.